Good morning. This is Mike McCauley. It is Friday, April 23rd. Welcome to Insights with Mike. Helping me out today is Mallory Vaughn. She's our editor, director, producer, and we're here with you every Friday morning. It's our favorite part of the week. So let's get right into it and start talking about some things that are going on. I'm changing up the order a little bit this week because there was some pretty exciting news in housing. That was the most common question that was asked this week, and that was about housing starts. We know before that I think that April, October are kind of the keys on housing, how housing goes. And you can see that in March, these are our March numbers, they really popped up again. And it's quite a surprise. Everybody's a little shocked at that. And so now we'll have to wait to see what happens in April, but these numbers really took off. And we want to be above that red dotted line. We are comfortably above that, considering where we've been the last year. It's just amazing we've made that recovery. Now we have a couple of issues going on. One is the price of lumber, which is up still about $1,000 per thousand board feet. And that's adding about $25,000 to the price of a 2,000 square foot home, which is about average. But the demand is still pent up. And according to the numbers I'm reading, we're still short about 4 million homes, single family homes that are in demand. And I know that in my neighborhood, there are no homes for sale. And when they go up for sale, they may be up for 24 hours. A friend of mine didn't tell me exactly what he sold it for, but he put his house up and told me that he got about 18% more than what he was asking, which is just a phenomenal number. Now, this isn't localized. We're seeing this all over the place. Canada, their March housing starts were also up 19% versus the same time last year. And some people are going to say, yeah, but that was March, that was COVID. Well, it was at the beginning of COVID. So it still is a pretty big number that their March year on year was 19% above 2020. So you have a worldwide demand going on. Now, it is interesting. Housing is a cultural issue. So here we have 30-year mortgages. The average time in a home is about 7.5 years for any family. In Japan, they have 100-year mortgages. It's not untypical at all for the homeowner to pass his mortgage down to the only child. But still, all in all, around the world, there's a demand for housing. Part of that is just a natural shortage. Part of it is interest rates. And if this is true, and that $4 million or 4 million housing starts short is true, then we're looking at probably a 2, 3, 4 year run, maybe 5, on a good housing market, provided that the economy doesn't hiccup anywhere along the line. So that's actually good news. And next April, well, actually 4 weeks from today, we'll talk about the April starts and see how we're doing there. But incredible news on the housing market in March. So consumer confidence came out last week, and also good news. The base we use is 1985, where we set it 100. Let's call that par. February consumer confidence was down to 90.4, and it just took an enormous jump in March. The global is up 10 points, Asia Pacific's up 8 points, Europe's up 11 points. So worldwide, this is a positive thing that we're starting to see an increase in consumer confidence. Consumer confidence is largely emotional, but it does drive the market. It makes more people comfortable to go out and do things, to buy things, to spend money, to get out and experience and use some of their assets. So those are generally good things to see. And it's something that we keep an eye on. 109 is just incredibly high, and we'll see if that holds true and keeps going forward. But that's where consumer confidence was, and it's something we really pay attention to. So the Dow Jones Industrial Average, in a second, I'm going to show you a little piece where I break it down, but we didn't have a stop this week. We had kind of a hiccup, maybe a little bit of pause. Yesterday, we were doing okay. And then an announcement was made about some ideas on increasing capital gains, and that caused a decline. Right now, the futures looks like they're going to try and recover a little bit. So it may have been a little bit reactionary, but still at the end of the day, when you step back and you look at 1 year, and you're going down way back down here to where we were about 18.5, and here we are, sitting there at 34,000. It's a pretty neat thing to see, and it shows that if you just have a good plan and invest, the market's doing pretty well. Will we have a setback? It's easy to say we're going to have a setback. We have a recession. We have a setback in the market about every 7 to 9 years. So the answer is yes, we will. It's a matter of when it'll come. But right now, things look reasonably stable. So next, we have the last 10 days. I wanted to look at that because I'm going to call this a little bit volatile. The blue line is the daily number, and then the orange line is the moving average. So you can see we've had some up and down days. Obviously, yesterday was a down day, and the day before was an up day. And the reason I'm looking at this is because of the volatility and what we did from the moving average, where we dropped down to about 33,725, and now we're back up to, a comfortable number 33,920. But it still shows some where it's kind of flattened out, and something we want to pay attention to. We're looking for that trend where we may want to be going down, we may want to be going up. Pretty much everybody that's a specialist and most of the really high-powered economists believe that we're on the precipice of breaking out either high or taking another decline. And everybody kind of feels like we're about there. So we're paying attention to these short-term moves. Here we're looking at the trees. That past chart, we're looking at the forest, and we're going to keep an eye on that and see where we go. We're going into summer. I still have good positive thoughts about summer. Weather gets good, people are getting out, companies are hiring, travel's picking up, and I think those are all good signs. So this is our US sectors. I have dropped out that 52-week as I promised I would, and now I'm just looking at 2021 year to date. Generally, you can't take these and multiply them by 4, but you can take them and multiply them times 3.5, and that's where we shake out to. All the sectors are doing, I'm going to use the word solid, except telecom, and that still surprises me a little bit because of so much what we do right now is telecom based. And we'll see how that changes over the next couple of months. But right now, these are the sectors and how they're doing. Basic materials, you're going to see that continue to do well. Consumer goods, you're going to see that do well. Your consumer services do well, as long as those housing numbers keep going up. Financials are the same. Financials are driving everything in the housing market. You've got to finance, you've got to carry loans, you've got to carry construction loans, you've got to finance the property. The other thing that's important about this is what doesn't really take an effect is skilled labor. And the housing market, which is doing so well right now, is a huge user of skilled labor. And we're short skilled labor right now. So if I was going to be advising young kids what to do, that would be a great place to go learn something today, is some skilled labor, a finish carpenter, somebody that can do flat work and concrete, even a framer. These are areas where we're going to be short. Right now, we used to say that it takes 9 months from the first dig in a house to turn the key. And we may be looking at a year if this shortage of skilled labor keeps going on. So you don't see that on this chart, but what we see is basic materials, services, goods, and financials. This is our world markets. You can see that that column next to the last, that's the week. And it wasn't a great week almost anywhere. The UK is down 1.1%. And that's consistent with us, and it's consistent with Japan. But still, that's the trees. Look at the forest on the right-hand side year to date. All of the countries are still up. In the worst case we have is Japan at 6.4. And then you have Australia at 7.1, the UK at 7.4. And then you have NASDAQ at 7.2, which is interesting. That's our tech heavy index. And it's performing well. It's just not performing as great as it has the last 8 years. So that's where we are today, or as of close of market last night. Treasury yields, you can see that we've still taken that little bit of a breather. We're dropping a little bit. Not much of a concern at this point. The low interest rates are going to drive a lot of good things. You got 1.686 this morning on the 10-year Treasury. That's a reasonable number. It's a good number. It'd be great if it was 3, but we're not going to see that for a while. So remember, the most important part now is that spread between the blue line and the orange line. We need something in there to reward people that are willing to take risk for a longer amount of time. Let's call that's what that indicates. And so we're looking for that spread to be there, and as long as that's there, we're okay. Then you have unemployment claims. The good news here is we're back down. We're below 575,000 for the week. The numbers yesterday. The orange line is being drawn down further. That's the moving average. We need that line to get down. We're almost to the double point, meaning that we have twice as many claims as I like to see. I'd like to see it at about 225, 230,000. We're at 574 yesterday. So that number keeps drifting down, and it's the lowest number we've seen in quite a while. That's really good. So we'll see if that continues as the weather changes and as summer comes along. And don't forget, we also have a lot of people entering the work market here in about 4 weeks and 5 weeks from graduation. We'll see how that affects us. So our calendar coming up. Next week is Community Bank Week celebration. We'll be doing some things here in the bank, and everybody's welcome to come by. And we have a May Day coming up, and I'll talk about that in a second. On April 26th is durable goods orders. We'll see how that goes. Again, housing starts on April 27th, consumer confidence index. The numbers I showed you are kind of estimates. We'll see how tight that was. And the other thing is homeownership rates. What we know is homeownership percentages have dropped, and we want to see if that's going up. It's always been, to me, kind of low when you're talking about only 60% of people own a home. That to me sounds like a low number, but it's actually drifting down toward the halfway point. We'll see if these low interest rates have helped that a little bit. We know there's pent-up demand. Jerome Powell's press conference is going to be the 28th. And the next thing that's of so much importance is the GDP quarterly numbers are going to be April 29th, and we'll be watching for those. Then, of course, consumer spending. How are we spending our money? And we are spending some money. And consumer sentiment. April 30th is our May Day open house from 10 to 4. We're going to be here at the bank, have a lot of games going on, contests, trying to make the day fun as possible. That's the May Day open house on April the 30th. And then Mother's Day is May 9th. And remember, Mallory and I are going to be taking a little bit of a break in probably the second week of June or so to the 4th of July, just to kind of retool and allow us to take some vacation times and get summer going. And that's usually a quiet time anyway. So we're always here for you. Call us at 913-259-2110. We're watching out for some things in the market. Yesterday was kind of an anomaly. It gives us an opportunity to talk for just a second about the difference between Keynesian economics and Adam Smith economics. And Keynesian is John Maynard Keynes. He's an economist and really kind of promotes a lot of government hands-on, government getting involved. Adam Smith isn't actually an economist. He's more of a philosopher. And he's, we call it invisible hand economics. So I think the interesting part here is the FOMC, the Fed, Jerome Powell and his group have to walk a fine line between those two theories, between actually getting involved and making changes or standing back and letting the market take care of itself. Today will be interesting. I think that the reason is we saw it drop because of the mention of capital gains tax, and we saw the market drop pretty quick. And now we'll see what happens this morning if standing back and doing nothing allows the market to aggregate back to a normal number. And I will admit, I'm more of an Adam Smith kind of guy. I think if we leave it alone, it'll aggregate back to where it belongs. I think that if we put too many rules and stipulations on it, we're just manipulating, and I'm not a big fan of that. So we'll see today if Keynesian economics or if Smith economics overrules on the market. Other than that, it's a quiet week, ready for some rain today. Everybody have a great weekend, and we'll see you back 1 week from today. 8 o'clock in the morning. We really appreciate y'all joining us. Have a wonderful weekend.